I'm Jim McMacken from Morris James, and I'm going to introduce Nick Moriello from Health Insurance Associates. He's going to talk about what you don't know about the Affordable Care Act. So, welcome, Nick, please.
Thanks. I'm going to attempt to go without the microphone. If anybody has trouble hearing me, just let me know and I'll switch. But I was asked to talk today about the Affordable Care Act. So most folks, I'm sure, are familiar with the Affordable Care Act, at least in general terms. And you know, folks refer to it all the time as Obamacare, or healthcare reform, or ACA, which is short for Affordable Care Act. But the full name is actually the Patient Protection and Affordable Care Act. And it was passed into law back in 2010, in March of 2010. And it completely changed the landscape for how health insurance in particular is delivered and purchased. So I wanted to talk today about some just general pieces about the law. And also, what I'd like to do, if it's okay with you guys, is make this very conversational. So please feel free at any time during my discussion here, just raise your hand, jump in, ask questions. I like fielding questions on the fly. I think it'll make it more informational and entertaining for all of us. So please jump in if anything occurs to you. So, law was passed March 23rd of 2010. And everything changed for us in the health insurance world at that point in time. I should back up a step. I'm a health insurance broker. So I run an agency down in Newark called Health Insurance Associates. And what we do, we help employers pick out health plans for their employees, and we help individuals who need to purchase health insurance on their own for a variety of reasons, and folks that are of Medicare age that need help with Medicare plans. So we deal with insurance every day, and specifically health insurance. So this was a pretty dramatic change for the way that our business operates and the way that most of our clients purchase and interact with their health insurance. So one big thing that it does is it requires all private sector employers, employees, people basically to have health insurance. There's new penalties for not having health insurance. There's penalties if you're an individual without insurance. There's penalties if you're a large employer who doesn't provide health insurance. But we'll go into a little bit more details about that. But basically it means you have to have health insurance is the goal of the law. So for those who don't have access to a plan through an employer, you know, they're going to need to purchase coverage on their own or enroll in some sort of coverage on their own. So, there's this new phrase in the insurance industry that's come out in the last couple of years because of reform, and it has to do with when an insurance policy was in place. This phrase is grandfathering. So if you have insurance, if you purchased it on your own, if your employer is providing you health insurance, the most important thing, that was the first question folks had, is their insurance policy grandfathered? Grandfathered means that it's outside of the law's requirements. It's that whole phrase that we've heard over and over again, if you like what you have, you can keep it. That turned out to be true if you have a grandfathered policy. Grandfathered means that the insurance policy existed before the law was passed, so before March 23rd of 2010, and that no changes have been made to that insurance policy since the time that it passed. So I'll give you a perfect example. Perhaps you're a person who has bought an insurance policy on your own, maybe you're self-employed. You've had the policy for a number of years, and on 1 year, on your anniversary of your policy or your renewal, the insurance price went up. And as a way to kind of offset some of that price increase, perhaps you increase the deductible on your insurance. That constitutes a change. And so if that change happened after March of 2010, it means that that insurance policy is no longer grandfathered. Policies that weren't grandfathered weren't allowed to continue any longer starting this year, 2014. So people that had insurance policies and made these changes, or perhaps they bought a new policy after 2010 that wasn't grandfathered, that meant when they got to this year, that insurance policy is going to end if it hasn't already. And those folks or those employers would need to go purchase new health insurance that complies with the law. New policies are governmentally standardized now, and they have to adhere to requirements to cover certain things. These things are called minimum essential benefits. So every insurance policy out there, new policies, they all have to do this certain list of things. Well, every state got the option to take the list of federally mandated items, these minimum essential benefits, and add to them if they wanted to. So states had to decide how to interact and implement healthcare reform. So in Delaware, the governor appointed a commission called the Delaware Healthcare Commission. And it consists of several members who have voting seats. And they were charged 3 years ago, or 4 years ago now, with the job of deciding how would Delaware implement reform. And one of the big decisions they had to make was, here's this list of minimum essential benefits that the federal government is requiring. Are there things that we as a state want to require above and beyond what the feds require? And Delaware did add a few things to our list of minimum essential benefits. This healthcare commission, by the way, they meet regularly, but once a month they have a meeting that's open to the public. So anybody can attend these meetings and weigh in on your 2 cents worth in terms of what should be covered, how implementation of reform should be going. They happen to meet the first Thursday of every month, so coincidentally they're meeting as we're having this meeting right here this morning. So, I want to think about employers for a moment. So for those of you that are employers in the room, employers have a couple key questions. First is, am I required to offer insurance? Because the law does require employers to offer insurance if they are of a certain size. That size happens to be 50 employees. Now, much confusion has come up because of reform in terms of how do you count employees. The technical piece of the law is full-time equivalents. And so basically what an employer would do when counting their employees, every full-time person would count as one person. But every hourly person, their hours would go into a big cumulative kind of pot and divide it by what is full-time equivalency. And so every 2,080 hours roughly equals another full-time person. So there may be a business that employs a lot of part-time people. Well, every so many part-time persons equals another full-time person. So 50 full-time equivalents is the bar where an employer is going to be required to offer coverage. If an employer has less than 50 full-time equivalents, then they're not required to offer coverage. They certainly can if they want to, but not required to. So, what is minimum coverage? Not only are those over 50 employers required to offer something, they're required to offer something that has all of these new minimum essential benefits that we discussed. And for small businesses that want to offer coverage and individuals who purchase coverage, plans that include these minimum essential benefits have now become governmentally standardized, and they are metallic, meaning bronze, silver, gold, and platinum. So when somebody's shopping for coverage as a small employer or as an individual, their options are bronze, silver, gold, and platinum. And just from kind of a generalistic viewpoint, a metallic plan has to be equal to a metallic plan from one insurance company to another. So just to use a common example in our local marketplace here, our Blue Cross is called Highmark, Blue Cross Blue Shield of Delaware. One of their large competitors is Aetna. An Aetna Gold policy and a Highmark Gold policy have to be statistically equivalent to each other. So gold is gold, bronze is bronze, regardless of the insurance company. Did that make sense? Okay. So large employers have to offer coverage. It has to do the minimum essential benefits, meaning it has to be at least as good as a bronze plan, covering all the same things. And then the next key is it has to be affordable for employees. There's also a new definition under the law of affordability. So when an employer provides health insurance to an employee, if the employer doesn't pay 100% of the cost of those benefits, the portion that they charge the employee cannot exceed 9.5% of what that employer pays that employee. That's the new definition of affordable. So if, just as an example, if an employer pays a person $30,000 a year, rough math, the amount that they charge that employee for his or her coverage couldn't exceed about $300 a month. So at 10%, it's too much. It's not deemed affordable for that employee any longer. So another question for employers are, do they want to offer health insurance? You know, what are the advantages to offering it in terms of employee retention, attracting good employees, complying with the law, etc.? What are the consequences to not offering coverage? Am I subject to penalties and so forth? With all these questions, am I required to offer it? If I offer it, does it meet the minimum level of benefits? Is it affordable for my employees? And basically, do I want to offer it? These are the main questions facing employers due to the Affordable Care Act. So, options. This is the landscape as it stands today. And I've mentioned a lot of things about Delaware up to this point. This is really a federal law, so it's affecting employers somewhat equally all around the country. Every state had a little bit of flexibility with how they could implement reform, but the main structure of reform is the same. So if you have a Pennsylvania-based business, or a New Jersey-based business, or Maryland-based business, or clients with businesses in those states, the same basic rules apply. There's just some minor nuance differences from one state to the next. So I wanted to talk first about what kind of options does a business have if they have fewer than 50 full-time equivalents. And these are the basic options that are out there. There's 6 things listed. By the way, for anyone who would like a copy of this presentation, we'll be able to get that to you after the presentation as well. But first option is this new option, which is you can offer insurance through something called the Shop Marketplace Exchange. This is a newly created environment under healthcare reform law that's like a virtual place to go to purchase insurance. And it's called the Shop Exchange. That's initials. It stands for Small Employer Health Options. And so there's this Shop Exchange where you can go and shop for insurance. In Delaware, we have a Shop Exchange. It has 2 insurance companies available for employers within the exchange. It's, again, our local Blue Cross, which is Highmark, and Coventry Healthcare, which is a subsidiary of Aetna. There's another option. An employer can purchase directly from an insurance company. That's no different today than it's always been. That's always been an option for employers. They could go right to an insurance company and purchase insurance, or work with an insurance broker or agent like us and purchase insurance for their employees. That option hasn't gone away. It's still there. Another new option is employers can purchase coverage through something called a private exchange. A private exchange is basically an entity that will arrange for insurance options for employees. What can be attractive about a private exchange is an employer could provide a certain amount of money for employees to use, And the employees can go into this private exchange and make shopping selections on their own. And then the administrator for the plan accumulates the employee choices and basically creates a billing arrangement to the employer. So the employer would get a bill every month, can payroll deduct from each employee the employee's portion of whatever selections that employee has made. So it gives some more option to employees. That's a private exchange. Another option is something called a defined contribution plan. So a defined contribution plan is where an employer can either work in a private exchange or direct from an insurance company, but instead of paying for the insurance or paying a percentage of the insurance, the employer says, I'm going to pay up to X number of dollars per month. And that number can be set by the employer. Just as an example, maybe say $300 a month. And so the employer says, I give everybody $300 a month, spend it as you like. And the employer would then interact with this private exchange or the insurance company directly, making their choices. But the choices in a defined contribution are usually limited to a kind of a pre-canned amount of choices, like 3, 4, 5 choices. So every employee can choose between those 5. It's not the whole unlimited world of insurance to go buy a plan from. But defined contributions are becoming popular as well. One of the challenges with a defined contribution plan is if the employer sets the dollar amount too low, then the price that the employee is charged may become unaffordable for that employee, which could subject the employer to some penalties if they were in an over 50 full-time employee business. Another option, and we were having a discussion in the room here right before the presentation about this option. This has become a very concerning piece, but several employers have decided to go the route of, I'm not going to offer health insurance any longer. Instead of offering health insurance, I'm just going to give my folks a raise, a flat dollar amount, everybody gets the same, and let the folks go shop on their own. And then I kind of wash my hands of insurance at the employer level. The upside to that is it wipes out a fairly significant expense for the employer, and it puts the shopping choices in the hands of the employees. But the risk in this is that salary adjustment becomes taxable income for that employee, income that the employer has to match FICA taxes on, income that now goes into the workers' compensation calculation for that employer. And if ever that employer wanted to go back to the world of offering health insurance, it would be very difficult for that employer at that point to then pull back a raise that they gave to an employee in 2014 with earmarked to buy insurance. But this is happening fairly regularly, particularly in Delaware right now, because there's a very large price differential at the moment between personal health insurance plans and small employer health insurance plans. In fact, that differential at the moment is about 30%, with the personal plans being about 30% less expensive than a small employer plan. So it's very tempting for an employer to say, hey, this is going to be good for my employees. They can get a better price on their own. It's good for me. I wipe out the cost of the health insurance. I deal with it as a one-time raise and then kind of wash my hands of it. So we're seeing it as attractive for employers and employees, but there's certainly some risks involved in that option. And then, of course, for a business with fewer than 50 employees, they just can decide to not offer coverage in any way, shape, or form. There's no penalties to an employer with fewer than 50 employees for opting to go this route. So some employers don't offer it today, don't want to offer it, and if they have fewer than 50 employees, there's nothing in the new law requiring them to offer it. So before I shift gears to employers of greater than 50 employees, I wanted to pause here for a moment just to see if there's any questions out there related to small employer plans and options, really anything that we've kind of jumped through up to this point. No?
Is it correct
Yeah.
that to get the tax advantage for a small business with under 50 full-time employees, that the plan has to be purchased through the shop market and exchange?
Yeah, that's an excellent question. So the question is, just in case anyone didn't hear it, is related to tax credits for small employers. So another new twist under the law is there are tax credits available for small businesses who purchase health insurance on behalf of their employees, but there's some rules. So the first rule is, to be eligible for the tax credit, the business has to have fewer than 25 employees. Second, the average salary of the employees cannot exceed $50,000 a year. And that average would count anybody who gets a W-2 from that business. So what we run into fairly frequently is there's the owner of the business and perhaps some key employees who throw off the curve. So even when we have businesses who do have fewer than 25 employees, we haven't run into too many businesses who have fewer than 25, but also have the average W-2 salary being under the $25,000. But assuming both of those things are true, then the business is eligible for tax credits only if they go in option 1 here, which is purchasing through the shop exchange. So they don't have as many insurance choices in order to be eligible for the tax credit. So it does happen. We have enrolled some businesses who meet all those requirements and go through the exchange. For those of you in Delaware or Delaware clients or Delaware-based businesses, we're a little bit fortunate here in that our shop exchange was functional on October 1st of last year, the first day. Many of our neighboring states, the shop exchange was not available until more recently. So we do have it here. It is functioning, but it's tough to run into the employer of 25 or fewer, average salary of less than $50,000 who wants to offer insurance, and then go into the shopping exchange and purchase insurance. But if they do all those things, the tax credit is up to 50% of the portion that the employer pays for employees. You're welcome. Any other questions? No? All right. So let's shift gears over to large employers. So large employers, we talked about that magic number of 50. So 50 and greater. So for those folks, if they don't offer insurance coverage, they do face those penalties. This year, 2014, the penalty got postponed. So it was originally slated to begin this year for employers who don't offer coverage. If employers don't offer coverage in 2014, and they have greater than 50 full-time equivalent employees, they are not subject to the penalty just quite yet. Next year, the penalties would begin for businesses of 100 or more employees if they don't offer coverage to at least 75% of their employees. That was a very recent change to the law. Originally, there was no distinction between 50 and more and 100 and more, and the penalty was slated to start this year. But it got postponed. It got postponed 2 years for businesses 50 to 99. It got postponed 1 year for 100 plus. And 100 plus doesn't have to offer insurance to all employees, just 75% of their employees for next year. After that, it becomes 100% and it touches 50 and up. Did that make sense to folks? I know I jumped through some of those numbers quickly. So thinking long term, once we're in penalty world, basically over 50 has to offer coverage. And if you don't offer coverage, you face the penalty. So what is the penalty? The penalty is currently set to be $2,000 per year per employee. And if the employees go and purchase an insurance plan on their own and receive governmental assistance, the penalty then changes to $3,000 per year per employee. That's the initial penalty. it has scheduled changes each year. So year one penalty is either the 2,000 an employee or 3,000 employee if they got governmental help. I'll explain the governmental help for individuals in a moment. And in future years, it increases. And there's components to the law that allow the current scheduled increases to penalty to be changed. So basically, if the federal government sees that more employers are going the route of the penalty instead of providing health insurance, they can alter the penalty to coerce more large employers to continue to offer coverage. There's a calculation that a lot of large employers are going through. If they didn't offer health insurance today, they're saying, what costs me more? Offering insurance or paying the penalty? And in some instances, many instances, in fact, the penalty is less expensive than providing coverage. However, then there's no coverage. And there's other benefits to offering coverage in terms of attracting and retaining, quality employees. But aside from that, just the straight math of it, the penalty is currently cheaper than most insurance plans. So, what options do large employers have? They cannot go into the shop exchange. When a business has more than 50 employees, that's not an option for them. So their only options are to purchase directly from an insurance company, with or without an insurance agent helping, or going into one of those private exchanges that we discussed earlier. And the same methodology for a private exchange would exist in businesses of all sizes, small and large. Does that make sense?
Yes.
So, what about individuals? What about people who purchase health insurance on their own? Or they work at a business that doesn't have health insurance? Or they've retired, they don't have retiree health benefits, and they've not yet reached Medicare age. There's a host of varieties of why somebody might need to buy an individual health insurance plan. It may be self-employed or sole proprietor, or work at a small business without insurance. Many reasons. But for those folks, what options do they have? One option is they could shop in the marketplace exchange. The name of this has changed several times over the course of the last several years with healthcare reform. The full official name is the Federally Facilitated Marketplace. If the person buying insurance lives in a state that participates with the Federal Facilitated Marketplace. So earlier we talked about Delaware has this healthcare commission that was charged with implementing reform. The first decision on their plate was, do we want to participate in the federal exchange, or do we want to run our own exchange as a state? And Delaware initially wanted to run our own exchange. But when looking at the cost, we decided as a state that we didn't have enough resources to run our own exchange. So that moment in time, the decision shifted. The only choices were run your own exchange or rely on the federal government to run the exchange. And so we were shifting towards the federal government running the exchange as the method. I'm one of the folks who meets with the Healthcare Commission regularly. And I felt strongly at the time that we did not want to rely completely on the federal government to run our exchange. So we said, are there any other options? And we kept going back and forth, and ultimately Delaware was the first state to come up with this thing called a partnership exchange. So we're one of 7 states at the moment. We were the first state to have this, where the federal government runs the mechanism of the exchange, but our state still has regulatory authority over the exchange. So we're a hybrid. So some states, using our neighboring states, Pennsylvania as an example, are a full federally facilitated marketplace. You'll hear the initials FFM. So Pennsylvania is a full FFM. Maryland decided to run their own state-based exchange. So Maryland has their own exchange. And then Delaware is kind of in the middle with this hybrid deal of a federal-state partnership. Did that make sense to everyone? All right, so when people go to buy insurance on their own, they can go into this exchange if they like. Or they can purchase insurance through the more traditional methods which is going right to an insurance company to buy it, or visiting an insurance agent or broker, buying it online. There's a number of different ways for folks to purchase insurance. The advantage to a person going into the marketplace exchange is the government will evaluate their circumstances and their income to determine if the person is eligible for any assistance. So these are tax credits available to individual people. So if a person goes into the federal marketplace exchange and they say, I don't have access to coverage through my employer, or I have access but it's not affordable to me, meaning the employer charges me more than 9.5% of what they pay me, then the marketplace will say, okay, that's the first criteria for you to come in and get some assistance. Now we want to know what's your income. And if your household income is less than 400% of the federal poverty level, and you don't have affordable coverage through an employer, then you're eligible for assistance. So you can go into the federal marketplace exchange, or in Maryland, the state-based exchange, and you create an account for yourself and say, here's all the details about me. Here's my income, my employment status, my dependent information. And back comes an income-based determination that'll say, here's how much help you're eligible for. And there's two different kinds of help. For folks who are below 250% of the federal poverty level, they get two kinds of help. They get a tax credit, which can be used to purchase the insurance. It's technically advanced to the insurance company on the person's behalf. And then the insurance company just bills that person for the difference in cost. So if the cost was $400 a month and a person qualified for $100 a month of a tax credit, the feds send the $100 to the insurance company only bills the person $300, the difference. That's the first kind of help. When they're below 250% of federal poverty level, they get this second kind of help, which is called cost sharing. And the cost sharing will take a silver plan. Remember, we talked about plans being metallic, and there's bronze, silver, gold, and platinum. So if the person selects a silver level plan, and they're below 250% of the federal poverty level, not only will that person get an advanced tax credit to reduce the cost of the insurance, but they'll also get this cost-sharing subsidy, which reduces the actual out-of-pocket exposure somebody has for medical bills, deductibles, co-payments, co-insurance, things of that nature. So there's quite a bit of help. The big unknown question mark that I should have put right here in the middle of the page is, where do all those dollars come from? All the dollars that folks are qualifying for in advanced tax credits and cost-sharing subsidies, there's not a good methodology right now on where those dollars are being collected for the federal government to be paying them in terms of insurance benefits and tax credits. Originally, the thought was that tax penalties on employers for not providing health insurance would be enough tax penalty collected to fund the tax credit and cost-sharing subsidies on folks who buy on their own. But there's no penalties being collected in 2014. There won't be penalties in 2015 for the 50 to 99, and only some of the 100 plus employers are getting penalized. And that's only if they don't offer health insurance coverage. Meanwhile, the advanced tax credits and cost-sharing subsidies for individuals are occurring now, with the earliest being folks that signed up for January insurance, January 2014, this year. So it's a big future concern in terms of where those dollars are going to come from. But that's one option for an individual buying insurance on their own. They go into the federal marketplace exchange if they're going to qualify for some kind of assistance. As brokers, when we're talking to potential clients or our existing clients and they're saying, how should I buy insurance? Our first question now has to do with income, employment status. Do you have access to an affordable plan from your employer? If you don't, we want to go into the marketplace and see what kind of help you might get. If you make more than 400% of the federal poverty level, or you do have access to a plan and employer, then it doesn't really make sense to go through the Federal Marketplace Exchange. This, by the way, is healthcare.gov. So you've heard all the challenges that healthcare.gov had starting last October to now. The IT contractors that administer the website have been changed once. Looks like a second change is coming. The site I can share with you, we deal with it every day. It is better today than it's been at any point since it's open, but it is still challenging. There's issues with freezing, incorrect tax credit determinations happening, incorrect cost-sharing subsidies happening, problems where people enroll through the site, but their information never properly transfers over to the insurance company, so they're not actually enrolled when they think that they're enrolled. Folks don't get invoiced to pay their insurance, or when they do get invoiced, it's the full amount instead of the subsidized amount, or vice versa. It's the wrong subsidized amount. So there's still a lot of challenges that need to be worked through with the logistics. But they are improving there, and improvements do happen fairly regularly. But if somebody doesn't qualify for any help, or they don't want to deal with healthcare.gov, and they say, what else can I do? Then we go right to the traditional insurance companies and get them insurance. They pay full price. Their only options are bronze, silver, gold, and platinum. That's all the insurance companies really sell any longer. And that's what they go in to choose. There are a few, I'll call them outliers in the health insurance world, that sell insurance plans that are not compliant with the law. So some folks say, these prices are tough. I want to buy insurance, but I don't want to buy one of these bronze, silver, gold deals. There's a lot of these minimum essential benefits that I don't feel that I need. What else can I do? They can buy some of these outlying insurance companies, but they're becoming fewer and further between. Most insurance companies are deciding to only offer plans that comply with the law to kind of streamline their processes. There's not as many that don't comply. And if somebody does buy a plan that doesn't comply, they're going to be forced with potential individual tax penalties. And if a person decides to not carry insurance, bronze, silver, gold, platinum, through an employer or on their own, then they're going to be subject to a tax penalty. Currently, the tax penalty is $95 once a year, or 1% of a person's adjusted gross income. So another conversation that happens fairly regularly is someone might say, okay, my insurance costs $400 a month, my income is X, if I had to pay 1% of X, isn't that cheaper than buying insurance? For almost everybody, the answer to that is yes. It is less expensive to pay the penalty than to buy the insurance, but then you're walking around uninsured. So we have that conversation with potential clients and existing clients all the time. One of the things that changed in the personal world of insurance this year, insurance companies used to ask a person about their health. And if they didn't like their health, they could turn them away, or they could charge more, or they could exclude pre-existing conditions. None of that can happen any longer. So some of the devil advocate type questions are, a person might say, well, my tax penalty is not that expensive. An insurance company can't turn me away when I get sick. Why don't I just wait until I get sick and then buy insurance? And the timing potential problem for that person is, you can no longer buy insurance anytime you want. You can only buy it in an open enrollment period, or when you've had a qualifying life event, like you lost your job, you lost your insurance, you got divorced, married, etc. That's an event to buy insurance. But if you didn't have one of those events, you have to wait till the next open enrollment. So open enrollment, the next one happens to be November 15th. So if somebody didn't have insurance and they're paying a tax penalty, they think that's a good deal because the tax penalty is cheaper than the insurance, and then they get some catastrophic illness between now and November, they're kind of stuck because you can't get back in until November. And those outliers that don't comply with the law, they still ask those questions about health. So if somebody had that catastrophic diagnosis, they're not going to be able to qualify for those things outside of bronze, silver, gold, platinum. Did that make sense for everybody as well? Okay, good. So, other options. People can buy direct from the insurance company, they can buy through the marketplace exchange, or they might qualify for a governmental program. There are already governmental programs out there. States have Medicaid and the federal government has Medicare. Medicaid also changed this year as part of healthcare reform for states that decided to opt into what they call Medicaid expansion. So this is another one of those decisions for our Delaware Healthcare Commission here, and we decided that we did want to opt in to Medicaid expansion. In the past, folks would qualify for state Medicaid, which is free insurance, and it's fairly comprehensive insurance. They would qualify if their income was below the federal poverty level and they didn't have sizable assets and they didn't have living arrangements provided for them. So living arrangements, income, and assets all factored into whether or not a person qualified for Medicaid. For states that expanded, like Delaware, now living arrangements and assets no longer matter. It's only income. And instead of just stopping at the federal poverty line, it now stops at 138% of the federal poverty line. So that magic number is $16,100 for a single person, and it changes based on the size of the family. So if somebody's out there with less than $16,100 of income, it doesn't matter how many assets they have or what their living arrangements are, they're going to qualify for Medicaid if they live in Delaware, and they can sign up for free. Over next door neighbor of Pennsylvania, Pennsylvania decided not to opt in to Medicaid expansion. So the old rules still apply for somebody living in Pennsylvania. This is another big new expense for states that did decide to expand. Initially, there's some federal dollars for the state, so Delaware is not taking on this big new expense immediately, but eventually we'll have to find a way to pay for this as well as a state. Medicare. Medicare is traditionally available to Americans who reach the age of 65 and have worked so many calendar quarters in their lifetime, but it's also available for disabled folks. So another conversation for folks who are in need of personal insurance is to find out if they're eligible for Medicaid at their state or Medicare at the federal level based on their age or if they're disabled. And so we look at those options for folks as well. So when folks are thinking about buying insurance, this would apply to an employer buying for their employees or an individual buying for him or herself. There's a couple of main topics that I just wanted to touch on briefly that people should consider, aside from the tax credits and availability of any help. It's the actual logistics of the insurance policy. So most insurance policies have deductibles. And now, most deductibles are what I like to call all-encompassing cumulative deductibles, meaning the insurance is going to work very similar to what you might be familiar with on your car insurance. It's not going to pay for anything until you reach your deductible. Not all policies are like that, but most are going in that direction. And so a person has to consider what deductible could they basically manage if something happened to them. The deductible in itself isn't going to be a hardship. The higher a person can tolerate on a deductible, the lower the monthly cost of the insurance is going to be. Co-payments. Some policies still have old-fashioned co-payments where you go into a doctor and instead of dealing with a deductible, you show an insurance card and you pay a co-payment. 10 bucks, 20 bucks, that kind of thing. Most co-payments are trending in the upward direction, so they're bigger than they ever have been before, and sometimes they don't occur until after the deductible has been met. So co-payments and deductibles are two big considerations. And then co-insurance. Co-insurance is when the insurance company and the person that's insured are sharing the medical bill. A very common example would be 80-20, meaning the insurance company is paying 80% of the bill and the person is paying the other 20% of the bill. When there's co-insurance, there's also a maximum out-of-pocket exposure for the person. So one of the big keys that a person needs to consider is 80% sounds great, but where does my 20% stop if I had this enormous bill? And so they need to look at where does the 20% or whatever the co-insurance that they have to pay, where does it stop? What's their co-insurance maximum or their worst case scenario so that that doesn't wipe a person out? And then lastly is networks. So networks are where the insurance works. And they can be local networks or they can be national networks. And that's an important deciding piece. You might be talking to a family, or maybe a family shopping, where they have a child that goes to college in another state. They may need a national plan. They may have doctors in neighboring states and might need a national plan. They may simply want a national plan in case something serious happened and they want to go to a famous facility in New York or Baltimore or Texas for that matter. So national versus local is another component to the conversation. National is generally going to cost more than local. And then lastly is the metal levels. We already talked about those before. There's bronze, silver, gold, platinum. There's also another category called catastrophic, but there's only limited circumstances when a person would qualify for catastrophic coverage. So, assistance. Where can people go for help? If it's an individual person shopping, they can go to these people called federal navigators. Navigators are funded by the federal government, but they're private organizations where a person can go, meet with a navigator, and decide, what options they have and can they get any help. And then there's also state-based guides or assisters. Here in Delaware we have, that's okay. We have 4 organizations that are assisters here in Delaware where people can go and meet with somebody, discuss their insurance options. And then of course there's insurance agents and brokers like us. The nice thing for our clients that work with an insurance agent or broker, brokers and agents don't charge fees. Consumers can work with them free of charge. They can work with navigators, guides, or agents or brokers, all at no cost to the member. The insurance is the same price regardless of where an employer or an individual were to purchase it. So that's all that I had to go over today. I really wanted to kind of keep a high-level overview of the changes and the options that are out there for folks. I hope that that was helpful. I'm happy to take any specific questions that anybody might have. Oh, thank you.
They've got a question.
Yeah, sure.
HSAs. So,
yes.
I noticed that the premiums on HSAs, at least across the board, it looked to me like they went up substantially.
Mm-hmm.
HSAs are for people, in my opinion, who understand the risk. They're willing to take on a higher deductible and so on. Can you talk a little bit about that as it reflects on the current option?
Sure. So his question was about health savings account eligible plans. So for the last several years pre-reform, the trend had been for individuals purchasing insurance and small employers purchasing to move towards health savings account eligible plans. Those plans combine an insurance policy with a big deductible, usually in the neighborhood of about $1,500 for a single person and about $3,000 for a family, where the insurance won't do anything until you meet that deductible. But separately from the insurance, there's a bank account called a health savings account where you can deposit money or an employer can deposit money on your behalf pre-tax. And you get a Visa debit card type of scenario where you can pay your medical bills with these pre-tax dollars that were in the account. The really nice thing about the accounts are if you didn't spend the money by the end of the year, you still own the money. It carries over year after year. It doesn't have that phrase, use it or lose it, the way flexible spending accounts do that a lot of folks are more familiar with. So I like health savings accounts. They've been a wonderful thing. However, all insurance, including the eligible health savings account plans, had a dramatic price increase in this part of the country this year, 2014. Because on all small employer plans of the past and individual plans of the past, the insurance companies factored health into the pricing. So if you had a person in very good health or a group in very good health, the pricing was good. Big deductible plan, folks don't tend to meet their deductible that frequently. It helped future price increases. But this year, there was basically like a one-time big adjustment because the insurance companies can no longer ask about health. They can't exclude pre-existing conditions. So all plans, even the most rich small co-payment plans and the more cost-effective health savings account plans, they all went up by a much bigger percentage than we had ever seen before. The math still holds true that comparing, say, a platinum plan with small co-payments and a health savings account eligible plan, which would be more gold or silver, there's still a big enough price differential between the two to justify the deductibles. But unfortunately, everything's had this bigger than historical increase this year. We're hoping that that levels off and it was a one-time adjustment, but really, insurance companies were shooting in the dark for this year. They didn't know what to charge when they don't know what to ask health-wise and can't ask. At the end of every calendar year now, insurance companies have to file all their finances with the federal government, where they show, here's all the dollars we collected from our customers, and here's all the dollars we spent in medical bills. And that equation has to equal 80%. If the insurance company spends less than 80% of what they collected, they have to give their consumers a refund for the differential. But conversely, if they spend more than 80 cents of what they collected, that's what next year's increase is going to look like, is basically that differential. So the law limits the insurance company's operating expenses, profit if they're a for-profit company, and compensation to guides, navigators, agents, etc., all to fit within that 20 cents. And for large employers, it's 85 cents. So they only have to operate on 15 cents. So it's challenging for insurance companies. Nobody knows yet if the rates this year were too high, too low. There hasn't been enough experience yet with these non-underwritten plans. But that's why the increases happened this year in particular. Good question.
With the HSAs, is there a parity rule that whatever's deposited for management, the same has to be for all employees, or can that be negotiated on a per employee basis?
Yeah, no, there are rules. Same discrimination type of rules that other plans would face. So deposits have to be equal amongst all employees. There can't be classes of employees for deposits any longer.
And is that a percentage, or is it a flat number?
It can be either. So it can be a flat dollar amount or a percentage. The only time you're allowed to make, as an employer, different deposits for different employees is if an employee is a single employee versus an employee who covers dependents. Those amounts can be different. But all single amounts have to be the same. All employees covering dependents have to be the same. And it can be a percentage of a deductible. It can be a flat dollar amount. It can be anything up to the IRS maximum for the year. IRS maximums for the year shift a little bit year after year. Right now it's roughly $3,300 for a single person, about $6,500 for somebody covering dependents. Any other questions? Yes?
What's the smallest group you can do these days? And the numbers are, under 50, over 50. So where do you see it kind of being more individual versus small group?
Yeah, so Delaware was a little bit unique in that we had our own law years ago that allowed for a business to cover as few as one employee. And that rule still exists. That business can't get tax credits inside a shop. The shop exchange requires at least 2. But a business can be as few as 1, as many as the stars. But what we're seeing is, just as a general rule of thumb, businesses that have lower income employees and are smaller in size, like under 25, that's where it's attractive to go to those individual policies despite the risks. White collar businesses that have really competitive hiring fields and are competing with larger employers to attract and retain help, those folks are still keeping health coverage and usually a pretty high-end plan like a gold or a platinum and paying a pretty high percentage of it on behalf of their employees.
I think we have time for one more question, if there is one. If not, I'd like to give a big round of applause to Nick. I want to remind everybody that Sam Cash